All right, so picture this a high stakes poker game, right? But instead of cards, we're talking entire sectors of the global economy.
Oh, I like where this is going.
Yeah, well, that's kind of the game hedge funds play. And today we're going deep on their latest moves thanks to some juicy analysis from Goldman Sachs.
Always love a good Goldman Sachs report. They really dig into the data.
Totally. They're seeing some big bets being placed and some even bigger shifts in strategy, which of course means big implications for all of us.
Absolutely, because whether we realize it or not, these hedge fund decisions can ripple out and impact everything from interest rates to stock prices, even job markets down the line.
Exactly. So we got to ask, where are these financial heavy hitters putting their money and what does it all mean? Let's dive in.
Let's do it.
First up, North America. For weeks, we saw hedge funds selling off, like it's going out of style. Now, all of a sudden, it's a comeback story. What's with the change of heart?
Well, it seems like there's a growing sense that the U.S. economy might be tougher than some initially thought. Like it might just power through all the doom and gloom predictions.
Okay, so we're not heading for a full-blown crash.
Not necessarily. The latest data, things like unemployment rates and consumer spending, hint at a soft landing. Basically, things are slowing down, but not falling apart.
hmm
And for hedge funds, that spells opportunity.
Makes sense. They're all about managing risk. So a bit more stability in North America sounds pretty appealing, especially with, well, everything else going on.
Exactly. And speaking of everything else, can we talk about China for a second?
Oh, yeah, the elephant in the room. Last month, it was all about piling into Chinese stocks. Now it seems like everyone's heading for the exits.
Total U-turn. And, there were reasons to be optimistic about China coming out of the pandemic. Everyone was expecting this huge economic boom, but
But it hasn't quite linked up to the hype.
not really. The recovery has been, well, bumpier than expected. Economic data is falling short. There are geopolitical tensions. And then you have China's government cracking down on various industries. A lot of uncertainty for investors who like a sure thing.
Which, let's be real, is what hedge funds are all about, minimizing risk for maximum reward.
Exactly. And when uncertainty rises, risk tolerance falls. Hence the sell-off. Goldman Sachs pointed out that they're specifically dumping H shares and A shares. Those are the Chinese companies listed on the Hong Kong and mainland China stock exchanges.
Right, right. So while some are playing it safe in North America, others are still making some targeted bets. Goldman Sachs highlighted three sectors in particular: healthcare, financials, and of course, good old tech.
Classics for a reason, I guess. Healthcare is just a smart long-term play. As the global population ages, demand for healthcare services is only going up. It's pretty straightforward.
Can't argue with that. And then there's the financial sector. Goldman Sachs found that hedge funds are piling in right before Q3 earnings season. In fact, they said it's the fastest they've bought since November of 21. What's the big deal about that?
Well, it suggests they're anticipating some really strong Q3 earnings reports from the financial sector. They're trying to get ahead of the curve, buy low, sell high, the drill.
The name of the game. Any theories on why they're so bullish on financials right now?
Well, some speculate it's tied to rising interest rates, which tend to be good news for banks and lenders.
Ah, yes, the classic interest rate play. And what about tech? Always a sector ripe for disruption and big gains.
Always. And while the overall market might be feeling a little risk-averse right now, Goldman Sachs still sees some really promising individual stock opportunities within tech.
Interesting. So even with all the talk of a slowdown, there's still a belief that the right tech companies can outperform.
Innovation waits for no one, right? But I think the real question here is, what do all these hedge fund moves mean for the average person?
Right, because it's easy to think of this as a game for the ultra wealthy, but these decisions have a way of trickling down.
Oh, absolutely. Like we said at the beginning, hedge funds wield enormous financial power. When they move billions, even trillions of dollars around, it impacts global markets. That creates a ripple effect that can influence things like interest rates, stock prices, even currency values.
So, for example, if hedge funds are driving up stock prices in certain sectors, like we talked about with financials, that could lead to higher prices for consumers down the road.
Precisely. Or, on the flip side, their withdrawal from a market, like what we're seeing with China, can create downward pressure, impacting everyone invested in that region. These financial decisions have very real-world consequences.
That's why we do this show. It's about connecting those dots, understanding those trends, and realizing that what seems like a bunch of financial jargon can actually hit close to home.
Exactly. The more you know, the better prepared you are to make informed financial decisions.
So, as we wrap up, I'm left thinking, if These hedge funds, these masters of prediction, are bailing on China. What are they seeing that maybe the rest of us haven't quite grasped yet?
Now, that's the million-dollar question, isn't it?
Question for another deep dive, perhaps.
I'm always up for it.
Until next time.